You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit uraniumspotlight.com, featuring in-depth market briefings, sector analysis, and the free Uranium Investor Foundation series. Essential reading for understanding today's nuclear fuel landscape. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's March 30th, 2026, and this week on Uranium Spotlight, African supply risks deepen. Kazakhstan asserts resource control, India signals future shortages, and Paladin advances a world-class Athabasca Basin project. The uranium spot price closed last week at $83.95 a pound, up slightly from an opening of $83.75. Market activity remained relatively measured, with modest volumes and a continued lack of urgency from utilities, even as underlying structural signals continue to strengthen. The long-term price for March held steady at $90 a pound, unchanged from February, reflecting a market that remains firm but not yet reactive. Trading activity continues to reflect a market in balance on the surface, but increasingly constrained underneath. Producers remain disciplined, prioritizing contract delivery over discretionary spot sales, while financial participation has been selective. Utilities, for their part, appear to be extending coverage quietly rather than competing aggressively in the spot market. What stands out is not price volatility, but price stability in the face of tightening fundamentals. With long-term pricing holding in incentive levels for new production and spot remaining unanchored in the low to mid $80 range, the market continues to signal that it is not yet under pressure, but is steadily moving in that direction. For investors, the key takeaway is that this is a market building tension rather than releasing it. The stability in both spot and long-term pricing suggests that the next move will be driven by contracting activity, not speculative buying. With growing attention on Africa as a future source of uranium supply, two major projects made meaningful progress last week, but the broader geopolitical context raises important questions about where that supply will ultimately flow. In Niger, Global Atomic's DASA project is approaching key financing milestones, supported by a 20% government stake and ongoing discussions with both development banks and strategic investors. At the same time, in Namibia, Bannerman Energy's Atango project continues to advance through construction, now approximately two-thirds complete following the sale of a minority interest to China National Nuclear Corporation. On the surface, these developments point to new supply entering the market in the coming years. However, the underlying ownership and geopolitical alignment tells a different story. Niger remains politically unstable following a coup and subsequent nationalization of foreign-owned assets, while Namibia is increasingly aligning with Russia and Chinese nuclear interests, including agreements tied to reactor construction. This raises a critical question for Western utilities. Even if these projects reach production, will the material actually be available to Western buyers, or will it be directed east under long-term strategic agreements? The recent trend has been clear. A growing portion of global uranium supply is being secured through bilateral agreements tied to reactor exports and geopolitical alignment, reducing the pool of freely available material. For investors, this matters because it reinforces the idea that not all pounds are equal. Supply growth does not necessarily translate into supply availability, particularly for Western markets. That segmentation tightens the effective supply picture and supports higher long-term pricing. If you want to understand the structural mechanics behind this, the full analysis is found in our Uranium Spotlight briefings at uraniumspotlight.com. In Kazakhstan, a significant development last week highlighted the country's increasing willingness to assert control over its uranium resources. Kazatomprom assumed control of a uranium deposit previously held by Uranium One, a subsidiary of Russia's state-owned nuclear group, after the asset reverted under the country's new subsoil use regulations. This marks the first instance of a project reverting to Kazatomprom under the updated legal framework, signaling that the government intends to actively enforce its resource policies. While Uranium One did not contest the transfer, the broader implications are substantial. Kazakhstan hosts a wide range of joint ventures involving Western and Japanese companies, many of which will face contract renewals in the coming years. The enforcement of these new regulations introduces uncertainty around ownership, control, and ultimately supply allocation. The key issue is not just ownership, but direction of supply. Kazakhstan has increasingly strengthened ties with China, which is aggressively expanding its nuclear fleet and securing long-term uranium supply. If future contract negotiations result in tighter state control or preferential allocation to strategic partners, Western utilities could find themselves competing for a shrinking pool of accessible material. For investors, this matters because Kazakhstan represents the largest source of primary uranium supply globally. Any shift in control or allocation has immediate implications for market balance, reinforcing the structural tightness that is not yet fully reflected in current prices. In India, a parliamentary panel called for increased funding for uranium exploration, highlighting concerns over a future supply shortfall. The proposed funding increase of approximately $12.5 million is intended to support the Atomic Minerals Directorate for Exploration and Research, with the goal of avoiding a supply bottleneck in the next 8 to 12 years. India's concern is well-founded. The country is rapidly expanding its nuclear capacity, but has limited domestic uranium resources. While it has secured long-term supply agreements with international partners, including recent deals with Canada and ongoing discussions with Kazakhstan, these agreements only address part of its future needs. The broader issue is timing. Exploration funding today translates into production many years down the road. A shortfall in exploration investment now virtually guarantees a supply gap later. What is notable is that India is openly acknowledging a future supply constraint, while at the same time taking only incremental steps to address it. A $12.5 million increase in exploration funding is unlikely to materially change the long-term supply outlook, particularly in a country with limited geological endowment. More importantly, India's action reflects a broader global trend. Governments are beginning to recognize the coming supply challenge, but the scale and speed of response remain insufficient. For investors, this message is clear. Demand growth is visible and accelerating, while the supply response remains slow and underfunded. This widening gap is the foundation for higher uranium prices over time, even if it is not yet reflected in the spot market. Paladin Energy's Patterson Lake South project continues to emerge as one of the most important uranium development stories globally, with significant progress achieved over the past year and a clear path now forming towards production. Following its acquisition of fission uranium in late 2024, Paladin has advanced the project through a comprehensive engineering review and secured provincial environmental approval in February 2026. The project is now moving into the construction licensing phase, one of the final steps before development can begin. At the core of the project is the R deposit, a high-grade uranium system located at relatively shallow depth, which supports a more straightforward underground mining approach compared to many Athabasca Basin deposits. The project is expected to produce approximately 9.1 million pounds a year over a 10-year mine life, supported by a reserve of 93.7 million pounds at an average grade of 1.41% U3O8. Economically, the project remains robust. The updated engineering review confirmed a post-tax net present value of approximately $1.3 billion at a $90 uranium price, with strong margins supported by low operating costs. However, capital costs have increased to over $1.2 billion, and the production timeline has been extended, with first production now expected in 2031. That timeline is perhaps the most important takeaway. Even one of the highest quality, most advanced uranium projects in the world requires the better part of a decade to reach production. For investors, the key takeaway is this. Patterson Lake South highlights both the quality of the next generation of uranium supply and the reality of how long it takes to bring it online. Even the best projects are years away from contributing meaningfully to supply, reinforcing the structural gap that continues to underpin the long-term uranium price outlook.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit uraniumspotlight.com. Join us again next Tuesday for another edition of Uranium Spotlight.